Hello traders, welcome to the #1 analysis on the whole internet on coronavirus. That seems like a bold statement. Have a watch of what I put together and I'm sure you'll reach the same conclusion. Check out the comments for how you can also receive this analysis. I'll send it directly to you. I've put it together myself from scratch. Guys, I use MetaTrader 4 to put this together. No rocket science. I literally downloaded the raw data from MetaTrader 4 and I'm going to show you why I've not been trading the last few days and what institutions are looking at to determine whether they should be trading during this volatility. There seems to be a lot of garbage posts out there from educators saying you're missing opportunity, this and that. Guys, it's not evidence-based. Institutions trade professionally based on probability, and I'm going to show you exactly what they're looking at, and it's not complicated. So number one, they're looking at the range, okay? Number two, they're looking at rotation, okay, rotations. And number three, they're looking at supply. Now we're going to quickly go through all three of those. Forgive me for going through very quickly, just obviously time is short, but this is essentially a distribution that I put together. Very basic, guys. Like I said, downloaded data from MT4. This is pound dollar. I literally did the high minus the low. I put them into buckets of pips to determine the frequency. How frequently over the last 6 months in a given bucket does pound dollar produce a certain range? So what we can see straight away from that analysis is, guys, one standard deviation. Approximately 70% of the time, the pound dollar is trading between 70 to 140 pips a day. Guys, what's it been doing during coronavirus? Friday the 28th, when the initial panic set in. Guys, almost 200-point range in the day. Look at that. The chances of that happening were about 5%, 1 in 20. Guys, what happened yesterday and today? 166-point range, again, in the extreme, 5%. Why would you want to trade that? Institutions have no interest in getting involved in that environment. Why? Because the chances of it working are very small. They're using certain techniques that work when in certain regimes and environments. If the environment is one way, 70, 80, 90% of the time we're in a given range, you suddenly blow through that range, what you're using in that environment isn't going to work anymore. So what institutions would rather do is take a step back. They're not gamblers. Guys, it makes no sense to trade in this volatility. Very quickly, we're going to apply this to, I was going to do pound dollar, but someone asked me about pound New Zealand dollar, and it was a great question. And I'm going to show you that, again, the same applies. We really shouldn't be trading when the market is given this type of volatility, because again, I've done exactly the same analysis, high minus low, there's the distribution. Guys, what has New Zealand dollar been doing? Well, typically, if you're an institution trading New Zealand dollar, you're making money when the market is ranging between 120 and about 240 pips a day. Okay, as soon as it breaks out of this range, guys, you're struggling to make money because your techniques are only well fitted into certain volatility regimes. Again, we can talk about that in another video, what techniques they're actually using, but this is where they're making their money. Suddenly, what happened yesterday? Guys, 1500 pips over here. The chances of that happening are, 1 in 100. It's not a great bet. So can you catch it? No. Why would you? Because if someone said to you, okay, you got one bet this entire week, and if you trade on a Wednesday, you've got 80 to 90% chance of winning. If you trade on a Monday, guys, you've got a 1% chance of winning. Which would you take? No brainer, you trade the Wednesday. But that's fine. This type of analysis isn't necessarily available in retail circles, and that's why I'm here to try and help you guys. And anyone can do this. Like I said, guys, MT4. And I'll send you the spreadsheet, no problem. Now we're going to move on very quickly to rotations. So what I've done here is I've basically put together, and let me start with pound yen. Similar sort of thing, guys. What institutions are interested in? Market goes up, down, up, down, up, down, right? Obviously not always in one direction, but essentially they'll be looking at rotations. How much does the market move in one direction before it reverses? I've used M15, 15-minute candles, but you can use whatever your time frame is. If you like to hold trades for an hour, Obviously, I don't hold trades for a day, so the day range is only going to tell me so much information. I typically hold trades for 10, 15 minutes to 30 to 1 hour. So I've gone with M15, done the same analysis, high minus low, put them into buckets, average them, and then what you can see is on Friday the 28th, when the volatility first started, guys, the average range was 25 pips. Guys, the market was very volatile. There wasn't much good opportunity without taking huge risk and huge drawdown. What do institutions like? Typically, pound yen to be between 14 to 20 pips on any given rotation. So 15 up, 15 down, 15 up, 15 down. As soon as we start deviating from that, institutions take a step back. They cut supply in the market, and I'm going to show you that. So you don't want to be trading, guys, when that happens. Okay, so just before I do that, let me show you pound New Zealand dollar as well, just because this guy asked me a great question on it. Similar sort of thing in pound New Zealand dollar. Okay, there's your range. So typically a desk would expect between 20 and 30 pips on any given 15-minute rotation, 20 up, 20 down, 20 up, 20 down. Now, how do you actually use this information? So what it is, we saw extreme readings on Friday the 28th and Monday the 2nd, right, when we first had a panic. So we were outside what is normal, and institutions step back, and guys, it's absolutely gambling getting involved when that happens. But then if you notice, volatility calmed down last week. So what you do is you start to observe this, guys. And we saw volatility calm down on Tuesday, Wednesday, bang, then you get involved. Right, volatility calmed down and got us back inside probability being high. And then again yesterday, guys, 60, today 32, we're again at the extremes. Wait for things to calm down, guys. The stats are telling it to you, okay? Don't rely on indicators, they don't tell you anything. Use statistics, let the market guide you, and that's what it's doing. We're just going to quickly take a look at supply and then end the video there. Alright guys, so here you see the supply of the market very quickly. These are the supply columns. Okay, and this is demand. And what you've got here is you've got the US Treasuries, you've got the S&P 500, okay, and then you've got Euro dollar here. Guys, the market's moving so fast I can barely keep up. But my point is this, guys, as I said to you, when volatility is high, institutions are not involved. Am I just guessing this? Am I just telling you because I'm grabbing this information out of thin air? No, guys. It is evidence, fact, based on reality, and that is here in the supply side, where you can see, guys, there's absolutely no supply. They've pulled it. It's all pulled. Normally on the S&P on any given day, you know, you'd expect 200-300 contracts. Right now, you've barely got 10-15 trading each side. On US Treasuries, guys, at 11:35 EST, I'm laughing because you'd normally see 2,000-3,000 contracts. You're barely seeing 200. On Euro dollar, you'd expect to see 80 to 100 contracts on any given liquid day. You're seeing 10-15. Guys, people are scared. They don't want to be trading this unless they have to rebalance their portfolios. No one's taking risk, guys. People are taking their foot off the gas. It's there. It's right there. The evidence is in front of you. Don't take my word for it, and certainly don't listen to someone showing you a gold chart that shoot up with a big candle, because it means nothing. Meaningless. This is what matters. Protect yourself, save your money for now, wait for volatility to calm down. Hope that helps, and I hope you agree that's the best coronavirus analysis on the internet. Check the comments. If you want the spreadsheet, I'll send it over to you. Cheers, guys. I was just about to post this analysis, guys, and I got this unbelievable email from one of the biggest brokers in the world saying they've recently reduced their spreads on some of the most popular indices so you can take advantage of the recent market volatility. Guys, let me assure you, retail brokers measure performance on how many people blew up accounts at the end of the month and how many new accounts were opened. They don't care if you make money. The chances of you succeeding in this environment, pound yen 361 pips today, 4%, peanuts. They're rubbing their hands with glee. Don't give them your money, guys. Add it as number 4 reason why not to trade in this coronavirus environment at the moment till volatility calms down. Range, rotation, no supply, and now your broker's after your money. Cheers, guys.